And we're just about a couple of weeks away from an expected rate cut by the Federal Reserve. The central bank has kept rates higher in an effort to tamp down inflation, but it hasn't raised or lowered them since July of last year. Current borrowing costs are at levels not seen since before 2007 to 2008, which is during the financial crisis. So CBS News contributor Javier E is here with me now in Studio 57 to break it on down. He's tapping away at his computer, getting all the numbers up. So thanks for joining us. Sure. Listen, you know, what's been happening over the past several weeks is all these numbers are getting adjusted, right? And I feel like I'm just swinging from one end to the other. Oh, it was good news, but now it's bad news, and it's changing again. But now I feel like really positive about this. This month we are likely to see a 25 basis point cut on the interest rate, federal interest rate. What's that going to mean for everyday Americans?
So we're finally getting what we've been hoping, wishing, praying for the better part of the last 2 years. Yeah. Lower rates. That's good news for anyone that has a credit card, anyone that has an auto loan, anyone that is hoping, wishing, and praying to maybe get a mortgage at some point.
Right.
This is, you know, and that's the big thing here, because that's really what's happening. And a big part of that is because people are staying in rentals longer because they just can't buy a house. They can't afford it. Yes.
Yeah. And I was thinking to myself, that's going to, I suppose when it comes to all these changes, it's the people looking for houses that are going to see the most immediate impact, because that interest rate can change, you know.
Right. And credit cards too. Like, and yeah, because the APRs are really high. As much as we talk about as high as mortgage rates are, credit card APRs are in the double digits. These are at like near record highs, if not record highs. And so some of that will start to ease, and you'll see a little bit of relief in your statements. Not a whole lot if you're carrying balances. And again, I always say the best thing you can do for yourself is pay off on a monthly, because if you're carrying balances, you're going to be paying.
I'm glad you said that, because I was going to say that's what experts say, pay off those credit cards first. Any reference or comparison to 2007 is going to have most people on edge. How does today differ compared to what happened back in the 2000s?
So the interesting thing, there's a counterintuitive fear that's been percolating in the minds of investors, Wall Street, that rate cuts may actually lead to a recession. So there's this data from Reiholtz Wealth Management that shows that since 1970, this is a really interesting statistic, and I wish I could pull the graphic up, but Fed easings have led to recessions, or seen recessions happen within 12 months about 10 times since 1970. And that's narrowly divided between rate cuts that happened but didn't cause recessions about 6 times. So there's this whole fear about, okay, we've been debating this a very long time. Did the Fed keep rates too high for too long? And now, as they start to ease, they're going to give us a nominal 25%. Maybe we'll get a 50 basis point cut. But the whole idea being, because they held higher for longer, the economy adjusted, but now it's in a much rougher place if had they cut earlier. So the whole question is, will the Fed's actions, they've been scrambling to avoid a recession or a hard landing of sorts.
Right.
Now there's a whole, debate about whether or not these rate cuts are coming at a time that's kind of too little, too late.
Right. If you've been living under sort of this weight of this inflation, you're not in the same financial position that you would have been in before. So even if the
jobs market is in a very different place now.
Right.
It's been very, very tight. Now it's much looser. There are a lot more layoffs. Still, to put it into context, the unemployment rate still low by historical standards, but it's not the go-go market that we saw 2021 through 2023.
That's interesting. Well, let's hope it's not that. And it operates the way we were hoping. Listen, before I let you go, I got to ask you about this DirecTV, Disney, Rift. My dad is a huge U.S. Open fan, and I know if there was a blackout, I would be hearing about it nonstop. So I can't imagine how disappointed fans are. What's the deal? What's going on? What are the financial ramifications?
2 multi-billion-dollar companies are fighting over money. And I wish I could say it better than that, but that's what it is. Look, the background here is these fights happen a lot. And it's fairly common, but it's a huge inconvenience to people like your dad and me, who's in fact a DirecTV subscriber. It's days before the NFL kickoff. I'm not happy.
Wow.
So there's a whole thing here, but to keep in mind, look, the era of streaming has made it really expensive for cable companies to keep customers from cutting cords. So people see their bill, they complain, why am I paying so much? I'm going to cancel. This makes it really hard for them to justify giving some sort of incentives just to keep customers holding on. Disney is a big player in the market, biggest name in showbiz, huge marketing power, and when they're backed up against the wall, they play hardball like they do here.
Yeah, and we already know that Disney has had sort of a rough few years itself with its own streaming platform and all that sort of stuff. So it's tough for media companies across the board. Javier E, thank you very much.
Yep.